In this lesson, we start to look at the details of each asset class, what the symbols and numbers mean, and how they are bought and sold. This will provide the basics of the different aspects we look at from a transaction point of view. The terminology and abbreviations are an important part of investing and trading, since all our analysis will almost certainly include these. I'll start with equities, since these have most of the details we use, and then I'll move on to other asset classes to talk about any details that are specifically related to them. So let's take a look.
Ticker symbols. When we look at any assets to trade or invest in, we will always come across their ticker symbols. They can also be called tickers or symbols. This ticker is the way that each instrument is identified by. We are usually looking at 3 to 4 letters. Equities. Here are some examples of equity tickers. Apple, AAPL, Tesla, TSLA, Amazon.com, AMZN, Microsoft, MSFT, ExxonMobil, XOM. Some companies may also have different share classes, so here is an example. Alphabet Class A, GOOGL, Alphabet Class C, GOOG. If you don't know what share classes are and want to know more, I suggest you look it up on a website like Investopedia.com to understand a bit more. Now, these are tickers for US equities. Some other exchanges may use a combination of letters and numbers as well, and we are more likely to find these in GDRs. The ticker of the exchange may also be included in there, especially if the broker we are using or the website we're on include equities from different exchanges. For example, London Stock Exchange may be seen as an L or LSE at the end of the ticker, such as GSK.L or GSK:LSE, which would mean GlaxoSmithKline shares traded in London. ETFs. Exchange-traded funds follow the same ideas as equities as we've mentioned in a previous lesson, since they're traded in the same way on the same exchanges. Some famous ETF tickers include VOO, Vanguard Index Funds S&P 500 ETF USD, IAU, iShares Gold Trust ETF, ARKK, ARK ETF Trust Innovation ETF. You may also hear the names of some famous ETFs when talking about the markets, especially SPY, which is an ETF following the S&P 500, and QQQ, which tracks the Nasdaq 100 index. Forex. As we've mentioned in an earlier lesson, when we talk about Forex, we are usually talking about a currency pair, so we use the tickers for two currencies. The first currency is what we are buying or selling, and the second currency is the one we are making the transaction in. For example, if we are trading GBP USD, it means that we are looking at how much each pound sterling is worth in US dollars, and the currency of the transaction itself is in US dollars. If we're looking at CAD JPY, it means we are looking at how much each Canadian dollar is worth in Japanese yen, and the currency of the transaction is in Japanese yen. Commodities. When we talk about commodities, we would also usually talk about them in the same way we talk about Forex, since we need to define which currency we are transacting in. For example, if we are trading Brent crude oil, the ticker could be BCOUSD, which means that we are looking at the price in US dollars. Some popular metal tickers include gold, XAU or XAUUSD, silver, XAG or XAGUSD. Futures. Future contract symbols usually start with a forward slash. For example, Russell 2000 futures /TF, natural gas futures /NG, platinum futures /HG. Currency futures usually start with a 6 after the forward slash. For example, Australian dollar futures /6A, British pound futures /6B, Canadian dollar futures /6C. You might also sometimes see some sites or people writing the futures symbol with an exclamation mark at the end instead of a forward slash at the start, but it is less common. Crypto. Crypto symbols use the same formula as currency pairs. So we would usually have the symbol for the cryptocurrency compared to US dollars, another conventional currency, or another cryptocurrency. For example, Ethereum to Bitcoin is ETH-BTC, Litecoin to US dollar is LTC-USD. Trade settlement. Trade settlement means the time it takes between buying an asset and it being legally in the new owner's name. In most stock exchanges, settlement for shares is either T+1 or T+2, which means that when we buy shares, it takes 1 day or 2 days until the ownership is in our name. Most brokers nowadays do not mention this, probably because they offer indirect ownership through derivatives, which we'll talk about shortly. Some assets such as Forex have T+0, which means that we we own these immediately without delay. This is normally because they are traded peer-to-peer or over the counter. Lots and pips. Lots and pips are terms that are mostly common in Forex trading. Some platforms would only make us trade in lots rather than absolute numbers. We'll look at some of these later in the course, but I'll just explain what these are here. One such trading platform, which is used by several brokers, is called MetaTrader, and it currently has two versions 4 and 5. MetaTrader 4 and MetaTrader 5 mostly run trades with lot sizes. We will go into more details of different trading platforms later in the course, and I'll show you the MetaTrader platforms as well. Anyway, one lot is 100,000 units of a currency. So if we're trading one lot of GBP USD, this means that we are trading the equivalent of 100,000 sterling in US dollars. We then have a mini lot, 10,000 units or 0.1 lot, micro lot, 1,000 units or 0.01 lot, nano lot or 100 units or 0.001 lot. 1 pip is 1/100th of 1%, which in currencies it means 0.0001 of the currency. For example, 1 pip in US dollar is equal to $0.0001. So 1,000 pips is 1 cent. So if we're trading with $1,000 and we have a gain of 15 pips, this means a profit of 15 cents. The only exception to this rule is Japanese yen, where 1 pip is 0.01 yen. Level 2 or depth of market. Level 2 table or the depth of the market is usually a list of all the bids and the asks on a specific asset. Let's take a look at these in pictures to explain. In this example, we are looking at the level 2 table for some asset. On the left, we can see the bids, and on the right are the asks. The two columns that interest us in each of these tables are the prices of the bids or asks and the sizes. Now, why is size important here? Let me try and explain this. If we look at the asks, this is how much a seller is willing to let go of their shares. So we can see here that there are 3 sell orders asking for 211.26 and their total size is 600 shares. This means that if I'm buying less than 600 shares, I will start buying from these. If I buy 610 shares, for example, I'll buy 600 shares at 211.26 and then 10 shares at 211.28, which is the following ask in the list. Now, if we go down the list, the price goes up and we can see different size orders, but then we can see that at 211.31, there is a large sell order of 1,688 shares. This means the price will not go above this level easily because there has to be buyers who buy more than these shares to go to the next price. This is important to understand because later on we will probably see this level on the chart as a resistance. The opposite is true on the bids side, where buyers are putting their orders in waiting for the sellers to come and sell them their shares at these prices. So here we start with the higher price of 211.23, where we have 2 orders totaling 700 shares. Then we go down to 211.22 for a total of 300 shares and so on. The sizes here are relatively small, but if we had a large size with one of the bid levels, this would be translated into a support on the chart. Level 2 is usually used by traders to gauge more accurate supply and demand levels and not just the chart support and resistance, since this way they can see how long they might be waiting for a level to be broken. Of course, orders keep changing constantly as more people want to buy and sell, so these tables keep changing quickly. Another way bids and asks can also be seen on the chart, where they are just represented as lines at different price levels. In this example here, we can see that there is a large size for bids just above 17.97, while we can see several relatively larger size asks above the current price. With something like this, we would assume that there are more sellers in this market and that it may be more likely that we see a sell-off with a possible temporary stop around 1850, where we can see large bid and ask sizes, but with larger ask size here. It takes a bit of experience monitoring level 2 or DOM action over time to start interpreting into what to expect in terms of price behavior. Not all brokers offer access to level 2 information, and some charge additional fees to provide access to them. They're not absolutely necessary, but they're important to understand and just know of their existence. Common order types. There are several ways we can place an order to execute a trade. I'll mention some of the most common types of these orders here. Market order. A market order means that as soon as you place an order, the order will be executed at whatever the current market price is. This means that if you're buying, you're paying for the first ask price, and if you're selling, you're receiving the first bid price in the order book. If you place a market order when the market is closed, the order executes immediately as soon as the market is open. Pending order, stop and limit. If you want your order to execute at a specific price, you would then place a pending order where you determine at which price your order should be triggered. You may also come across pending orders as limit or stop orders, which are two slightly different ways of placing a pending order. A limit order is an order where the price I want to enter the trade is better than the current market price. For example, if a stock is currently trading at $110, but I want to buy it at $100 or less, then I place a limit order at $100. This means that as soon as the price reaches $100 or less, the order will be executed. A stop order is one where I want to enter the trade when the price gains momentum in the right direction. For example, if a stock is currently trading at $110, but I want to buy it only if it breaks a resistance level at $115, I will place a stop order at or above $115. This means that as soon as the price reaches $115 or more, the order will be executed. Placing orders. Each broker's platform that we use will have different types of orders which we can place. Therefore, it's important that you get very familiar with the trading platform that you're going to be actually using before you start using it with real money. I'll include some general items which we can find on different trading platforms, but each person needs to explore their broker platforms more thoroughly. We'll go through more details of when we use each of the following later on in the course when we talk in more detail about trading and technical analysis, but let's have an initial look at them for now. Here are some terms you may find on your order box. Quantity, which is the number of units in the order. In stocks, this would mean how many shares, ETFs, how many units, and in currency, how much of the currency you will be buying or selling. Order type, market, stop, limit, as we've just explained them. Expiration or time in force, end of day or GTC, good to cancel. This tells the trading platform whether you want this order to be cancelled at the end of the day if it hasn't been executed, or if you want to keep it open until you cancel it yourself. OCO, one cancels the other. In this type of order, you may want to buy if the price reaches a certain level, but you may want to short sell if the price falls under a certain level. This type of order is specifically designed for traders who want a quick entry on either side according to price movements. When I talk more about technical analysis and trading in future lessons, I'll explain this type of order a bit more. Stop loss, maximum loss you're willing to take. This is set in advance to be triggered automatically. Trailing stop loss, you set the initial stop distance and it moves with the price. This type of stop loss is dynamic. A normal stop loss is set at a specific price. With a trailing stop loss, you set the distance between your price and the stop loss. If the price starts to move up, the stop loss level moves up as well, and it stops moving when the price comes back down. It will only start moving again if the price reaches new highs and so on. Take profit, the price at which you want to exit the position. There are some other elements to orders you may find on your broker's platform, so please make sure you're familiar with them and understand their uses. I may also be mentioning some additional terms when we talk about trading or options later on. General terms. There are some terms that are usually used in the financial markets that we could do with being aware of. Paper trading. Paper trading is a term used to describe trading using a practice account with no real money. This is quite an important step, not only for beginners, but anytime we use a new broker or a new trading or investing platform until we get completely used to it. I'll go into details about this later in the course when I talk about choosing brokers. Bulls and bears. When we talk about the bulls, we mean those who are positive towards the markets and buy aggressively. The bears are the opposing group and they are negative towards the market and sell heavily. We also call the types of movements bullish or bearish when we see more buying or selling in the markets. And if I'm bullish towards a stock, it means that I'm positive towards it, and if I'm bearish, it means that I'm negative towards it. Long and short. As I've mentioned in a previous lesson, going long means buying and going short means short selling an asset. So if I'm bullish on a stock, I would normally go long, and if I'm bearish on it, I would sell it or short sell it. Again, I'll talk more about short selling shortly. The trend is your friend. A trend is a general direction of an asset over a certain period of time. So if a stock price has been going up consistently for several weeks, then we would say that it is in an uptrend. And if it's going down consistently, we would say it's in a downtrend. The saying, the trend is your friend, highlights the approach by most traders, which means that they would take the trade only in the direction of a trend. So if the trend is up, they would only buy, and if the trend is down, they would sell. Buy the rumor, sell the news. I'll talk about this in lesson 6, as I'll need to explain certain elements of market dynamics first for this to make sense. Leverage, margin, and margin call. Leverage simply means borrowing money to increase the trading position sizes. For example, if my broker offers me 10 times leverage, it means that for every dollar I put in, I can buy $10 worth of assets. That $1 I put in is the margin. This borrowing normally comes in at a cost, which is the interest paid to the broker for this leverage. Usually, if we're only trading within the day, there is no interest paid. Interest is usually only calculated for positions held overnight. Here is an example of a trade with leverage. If we're not taking any leverage, we can see here that our $1,000 would have bought us around 3.8 shares of FedEx. Now, if we increase the leverage to 5 times, we can see here that it says exposure $5,000, which means that we can now buy 19.38 shares instead. The margin we are putting in is $1,000. If you look at the bottom of the trade box, you can see how much this would cost us if we hold the position overnight. So it would cost us 90 cents per day, and if we hold it over the weekend, it would cost us $2.69. Why would we want to take leverage? It is the potentially very high gains. So if this stock goes up by only 5%, we would actually be making 25% profit on this trade. On the flip side, this comes with much higher risk. So in addition to the overnight fees, we can lose more than we put in. If we stay with this example, if the stock price falls only by 10%, this will mean that we would be losing half of our money. You can see why this is risky, of course, since in theory, we can lose more than we put in if the price drops by more than 20% in this example. Different brokers would have different ways of limiting such risk of losing more than what we put in, so they would automatically close trades that are about to exceed our margin, and this is what is called a margin call. In this example, the broker here has a limit of ensuring the loss doesn't exceed 50% of the margin, and this way it protects the trader as well as they protect themselves. Short selling. When you buy an asset, you do so with the belief that the price will go up. Short selling works in exactly the opposite way of buying an asset. So when you believe that the price of the asset will go down, you can short sell it. How can we do this in reality? If you don't already own the asset, you can borrow it to sell it before buying it back later and returning it to the owner. Let's take a simple example to illustrate this. You go on eBay and find that a new iPhone 12 sells for $1,000 today. If you know that there is a new iPhone model coming out in a few weeks, you believe that this will mean that the current phone model will become much cheaper, maybe selling for $500. But you have a small issue. You don't own an iPhone 12. So you go to a friend of yours who has a spare phone still in its box and make a deal with her that you want to borrow her phone for a few weeks. You then go on eBay and sell the iPhone for $1,000, and now you have $1,000 in your pocket, but it's borrowed. The new iPhone is released a few days later as anticipated, and the price falls, so you go back on eBay, buy another iPhone 12 for $500 and return it to your friend. You keep the $500 difference, and you have made a 100% profit on this transaction. Now, let's say that after you sell the iPhone 12 for $1,000, Apple come out to say that they are not releasing a new iPhone model for at least another year. This may mean that the iPhone 12 might now be worth $1,100 and you have to return the phone to your friend. You will then have to go back and buy it for $1,100, meaning that you lost 10% in this trade. You can always limit how much loss you are willing to take by monitoring the price to make sure that if it hits your maximum tolerable loss, you'd just buy it back and return it. So you're setting a stop loss for this trade as you would with a long trade. Another element of short selling that works in exactly the opposite way of going long is dealing with dividends. If the stock we shorted is supposed to pay a dividend, it is our responsibility to pay the dividend, so it comes out of our trading account. In financial markets, there are several ways we can short financial instruments, and it depends on the broker we use and what services they offer in this regard. Some brokers would have a service where we can actually borrow the shares to sell, and these would be shares owned by other traders on their platform, while other brokers would do so using derivatives such as CFDs or options. Again, each person will have to explore what kind of short selling instruments and services are available to them through their brokers. Derivatives. As explained earlier in the course, derivatives are financial instruments that derive their value from the underlying asset. Two of the most common derivatives that are used by retail investors and traders are CFDs and options. CFD. A CFD is a contract for difference. It's a contract that has almost exactly the same qualities as the underlying asset, but the ownership of the asset is indirect. The price of the CFD usually moves in exactly the same way at the same time as the underlying asset, but with small differences in price, which is normally the broker's fees. The fact that CFD is a direct contract between the broker and the client, their trading hours can also be extended beyond normal market hours, as some may follow extended market hours, but this depends on the broker offering it. The financial institution that offers the CFD owns the asset, then this contract gives the person who buys it all the rights to the underlying asset. So, why not just buy the asset outright instead of this contract? There are several reasons, some of which include the ability to buy and sell using leverage. The broker offering the contract can provide contracts with specific leverage straight away, which makes it easier and quicker to execute the transaction. The ability to buy and sell fractions. This is important for small accounts that want to invest in large companies but do not have enough funds to do so. Brokers can then offer the option to trade in fractions by providing these to numerous traders. The broker then trades the actual shares, while the individuals can have the rights to the parts they can afford only. The ability to short the underlying asset. One easy way to short an asset is through a CFD, since the broker would have the flexibility to trade the asset in either direction quickly. The ability to buy and sell contracts. One way of trading commodities and indices is through CFDs. As with other financial instruments, the broker is able to offer their clients the ability to get the benefits of the underlying assets without directly owning them. So, future contracts of commodities and indices are very commonly traded using CFDs. CFDs are commonly used in Europe and many countries around the world. They are not used in some US states, and they're not used in Canada. Options. Options are contracts that give the bearer the right to buy or sell a specific asset at a specific price on a specific date. That specific price is called the strike price, and the specific date is the option expiry date. If the option is to buy the asset, it is called a call option. If it is to sell, it is called a put option. When traded, options have their own price, which is not the price of the asset itself. So, to begin with, we only pay for the contract and not the asset. The option prices derive their value from the current asset price and how likely the strike price is going to be reached by the expiry date. These are called the intrinsic and extrinsic values. We can buy and sell options which are for prices that have either already been reached or prices that are still to be reached. As an example, let's look at a call option, which means that we want to buy the underlying asset at expiry. If the underlying asset is trading at $100 today and we buy the call option with a strike price of $90, we call this in the money option. It means that the strike price has already been reached and surpassed, so as long as the price stays above $90, when we end up buying the asset, we will be profitable or in the money. If we buy a call option with a $120 strike price, this is an out of the money option. We will only be in the money when the asset price reaches $120 or more. If we buy the option with a strike price of $100, it means that we are buying it at the money. One last detail for now is that when we are trading options, we are normally trading 100 options at a time. So if the option is trading at $2, when we trade one contract, it will be for $200. This means that on expiry, we will be trading 100 shares of the underlying asset. I shall be talking about trading options in a bit more detail later in the course when I talk about specific trading strategies and different uses of different strategies. Some of the strategies I'll be focusing on are suitable for very small accounts. Options are more common in the US and Canada, and they're not as commonly used in Europe and other countries. Trading commodities and indices. Commodities. For the purpose of this course, when we talk about trading commodities, we are actually talking about trading the contracts and not the commodities themselves. We do not buy and sell the physical oil barrels or bushels of wheat, but we buy and sell the contracts. Moreover, most of the brokers we use as retail investors and traders do not offer us the option of buying and selling the actual contracts, because if they do, we could actually end up with a barrel of oil turning up on our doorstep. What we actually trade are then instruments that derive their value from the commodity prices or their contracts. One way of trading commodities, as I've just mentioned, is through CFDs. The CFDs would usually be for specific future contracts, so if they do not show the contract dates, we may need to dig a bit around the broker's website to find the contract expiry. The importance of this is that when we are trading contracts, we need to know when these are for in order for us to make better judgment as to the levels of supply and demand. Trading a contract expiring in 1 week can be quite different from trading a contract that expires in 8 months. There are so many variables that may affect supply and demand, which means prices will always be different. Another way of trading commodities is through ETFs. The ETFs would either trade in physical commodities or their contracts. For example, the ETF IAU is one that holds physical gold in actual vaults in several locations, and the price of the ETF is then reflecting the price of the gold held in the fund. On the other hand, an ETF like USO is one that tracks WTI crude oil contracts rather than trade the actual physical asset. Shorting commodities can also be done via CFDs or ETFs. With CFDs, we're actually able to short the CFD. With ETFs, not all brokers allow shorting ETFs, but there are inverse or contrarian ETFs which are purely for shorting the underlying asset. So instead of us shorting anything, we can just buy these ETFs to go in the opposite direction. Some of these ETFs are leveraged, which means that they don't just short with 1 time the money, but they may be shorting with 2 times or 3 times leverage. In this case, dealing with these ETFs requires an additional level of awareness, since their downside risk is usually higher than their upside risk due to time decay issues. As with everything else being said here, please make sure you understand everything you're doing 100% before doing it. If you're interested in leveraged ETFs, please do a bit more research on these. Indices. Just like commodities, when we're trading an index, we are actually trading the futures contracts. In the case of an index, though, we do not have the issue of buying something we don't want, so we can just buy the contracts themselves. We can also trade them using ETFs. Some of the most famous index tracking ETFs are SPY for the S&P 500, QQQ for the Nasdaq 100, DIA for the Dow Jones Industrial Average, RUT for the Russell 2000. There are also inverse ETFs for some indices. What we're able to trade depends on the brokers we use and what they offer. We just have to check which instruments they have available for us to trade these. Trading fixed income. When we want to trade bonds, again, according to the broker we use, we may be able to trade government bonds, corporate bonds, both or neither. There are also ways we can trade collections of bonds via ETFs like we could with commodities or indices. There are many different types of bond ETFs, so it would be good to explore what our brokers offer and which ones we would be interested in buying or selling. We will talk about bonds a bit more when we talk about portfolio construction in lesson 7. Volatility. Volatility is a measure of how some asset prices move relative to the way they would do in normal times. For example, high volatility means that price tends to move in quite a wide range, wider than it would normally trade in. This happens during times of uncertainty where buyers and sellers are battling it out with no clear direction of the asset, or during times of euphoria or panic. One famous and important measure of market volatility is the S&P 500 Volatility Index, or what is also known as VIX. This is an index that specifically tracks the volatility in the S&P 500 index, and some traders use it as one of the gauges of how markets may be behaving in the near future. Contract expiry. Since we trade contracts, these contracts have an expiry date. Most contracts expire on Fridays, with some having additional expiries, with the second most common day of the week being Wednesday. When contracts expire, the underlying assets need to be bought or sold to honor the contracts. Contracts can also be rolled over, meaning that they can be renewed after expiry. In reality, this means that two transactions need to happen simultaneously, one ending one contract and the second starting the new contract. During these times of contract expiries, markets tend to be very volatile since there is a lot of buying and selling going on, not because of the supply and demand, but just because of the contracts. This is one of the main reasons that the last trading hour on Friday is quite volatile, followed by the last trading hour on a Wednesday. Triple or quadruple witching. When different types of contracts expire on the same day, this means some added volatility that is much higher than normal, as well as much higher volumes than average. The quadruple witching is the most important of these events, and it happens only 4 times a year. It happens on the third Friday in March, June, September, and December. It's called quadruple witching because 4 types of contracts expire at the same time: index options, stock options, index futures, and stock futures. Exchange rates. When we're investing or trading, we may be looking at assets in currencies that are not our local currency. When this is the case, exchange rate fluctuations may affect our account value. For example, if I am based in the UK and buy US stocks in US dollar, fluctuations in GBP USD rates will have an effect on my account, which I might be holding in GBP. This is a small aspect that can sometimes become big if such fluctuations become significant. It should also explain why sometimes, even when the asset itself has gone up in value, our accounts may show negative results. It is important to keep this in mind. I'll talk in the next lesson about hedging, which could be one way of dealing with such fluctuations.
We've covered quite a bit in this lesson, and we will be using what we've spoken about here later on when we get into the details of placing orders to enter into positions or exit from them, as well as when we talk about strategies. In lesson 6, I will talk about market dynamics, where we will look into what moves the markets, what to look for if we're trading short-term or investing for many years, as well as explore the concept of hedging and how to decide what hedges can be beneficial to our portfolio. In lesson 7, we will start to talk about how to build a portfolio and having the basis upon which we will decide on our strategies and specific names to invest or trade in. See you next lesson.